Welcome back to Let's Invest with the ASX. In this video, we will be discussing managed funds. Managed funds pool money from multiple investors and are managed by professionals. Funds invest in a range of asset classes, including shares, bonds, property, and infrastructure assets. Investors are allocated shares or units in the fund, representing a portion of its value. Dividends or distributions may be received based on the fund's profits or income from underlying investments. Profit potential includes both income and capital gains from selling units at a higher price. Managed funds provide choice in terms of asset class, risk level, investment manager, and buying and selling options. Flexibility is offered through various access options, including direct purchase from the fund manager, trading on ASX like shares, or using the M-Fund service. Owning a managed fund is simple as the investment decisions are made by the fund manager. Managed funds charge fees, regardless of the fund's success, and additional fees may apply if the fund outperforms a benchmark. The complexity and accessibility of the fund's assets can impact the fees, with more complicated assets generally leading to higher fees. Fees are typically expressed as an annual percentage of the invested amount. Entry and exit fees may also apply, so it's important to review the fund's terms and conditions. The skill of the fund manager becomes a crucial factor in the investment outcome of actively managed funds. Market downturns can affect even skilled fund managers, so understanding the fund's investment strategy and the manager's experience is important. Reputable managed funds provide clear information about their investment strategy and the manager's background on their website and fund documents. Asset exposure. Australian shares. Managed funds allow investors to gain exposure to the Australian share market. These funds aim to outperform the relevant market index by investing in a subset of securities included in the index. Some managed funds focus on specific sectors of the market to cater to investors seeking targeted exposure. Strategy-oriented managed funds, such as high-dividend or value-focused funds, are available for investors with specific investment preferences. Managed funds distribute income, including franking credits, back to investors, usually on a semi-annual basis. International shares. International managed funds enable diversification into overseas markets and across companies within those markets. They can be single country, multi-country within the same region, or multi-region funds. Sector-specific international managed funds allow access to sectors underrepresented in the Australian market, like technology. Currency hedging may or may not be employed in international managed funds, and there may be additional taxation requirements. It is crucial for investors to thoroughly assess the risks associated with international managed funds before investing. Fixed income. Fixed income managed funds consist of a collection of bonds issued by various entities, including domestic and international corporates, governments, and semi-government organizations. The fund's portfolio is diversified by including bonds with different maturity dates, ensuring a balanced mix as bonds mature and new ones are added. Investing in fixed income managed funds offers a more stable income stream and lower price volatility compared to other asset classes like shares, making it a defensive investment. Income earned by the fund is distributed to investors on a quarterly basis. Buying and selling. Managed funds are classified as either listed, traded on ASX, or unlisted, traded off-market. The M-Fund settlement service enables investors to buy unlisted funds through their broker, alongside their existing holdings in CHESS. Listed managed funds can be bought and sold directly on the ASX. Unlisted managed funds can be purchased through the M-Fund settlement service, providing convenience and integration with existing holdings. Unlisted funds. Unlisted managed funds are the primary type of managed fund available to Australian investors. Prices for buying and selling units in unlisted funds are determined by the fund manager based on the latest valuation of fund assets. The prices can be obtained from the fund's website or published in national newspapers. Buying and selling unlisted funds involves an administrative process, resulting in longer transaction completion times compared to on-market transactions. It's important to carefully consider the features and risks of managed funds before making any investment decisions. Thoroughly reviewing the fund's prospectus and seeking professional advice, if needed, can help ensure a clear understanding of the investment and its potential benefits and risks. The M-Fund Settlement Service was created to address transaction delays and enhance price transparency for unlisted managed funds. Here is a simplified explanation of how the service operates. Unlisted funds join the M-Fund Settlement Service. Buy and sell prices for units in approved funds are displayed online. Instead of being directly traded on the ASX, purchases and sales of units occur between the investor and the managed fund issuer's unit registry. Investors do not trade units with other investors. The process is facilitated through the ASX settlement system, CHESS. Investors can transact in these units through their broker, similar to buying and selling shares. The entire process is conducted online, and the holdings in unlisted funds purchased via the M-Fund Settlement Service will be shown in the investor's CHESS holding statements alongside other holdings. When selling the holdings, the CHESS statement will be updated accordingly. Listed managed funds on the ASX include various types such as listed investment companies and trusts, Australian real estate investment trusts, infrastructure funds, absolute return funds, and pooled development funds. Listed investment companies and trusts. These investment vehicles are listed on the ASX and pool investors' funds to invest in a diversified portfolio of assets. LICs are traded on the market, with prices set by investors. Market prices for LICs can differ from their asset backing due to market sentiment. Unlike unlisted funds, LICs do not require asset sales when investors buy or sell units. Transactions for LICs occur on the market, allowing for liquidity and no direct redemption with the fund manager. Australian real estate investment trusts. These listed trusts invest in a portfolio of income-generating properties, such as commercial, industrial, or residential properties. AREITs enable investors to access professionally managed and diversified commercial real estate portfolios. Investors benefit from the value of the real estate holdings and regular rental income. AREIT investments can include office buildings, industrial estates, retail shopping centres, hotels, entertainment precincts, and overseas properties. The fund manager is responsible for property selection, maintenance, administration, rentals, and improvements. Infrastructure funds. These listed funds invest in infrastructure assets such as airports, toll roads, utilities, or renewable energy projects, providing investors with exposure to this sector. Infrastructure funds allow investors to own a portion of a professionally managed portfolio of infrastructure assets, including toll roads, airports, communications assets, materials handling facilities like docks, rail facilities, utilities such as electricity power lines and gas pipelines. Investors in infrastructure funds can expect a combination of capital growth and income. The income generated by infrastructure assets tends to be predictable due to operating in low competition environments with high barriers to entry. Absolute return funds. These listed funds aim to achieve positive returns regardless of market conditions by using various investment strategies, such as long-short equity positions or alternative investment approaches. Absolute return funds strive to generate returns in all market conditions. They employ unique investment techniques and trading strategies. Unlike traditional funds, they have flexibility in their approach, aiming to exploit market opportunities and maximize returns. Pooled development funds. These funds provide venture capital to Australian companies in their early stages of development, supporting innovation and economic growth. Pooled Development Funds, PDFs, promote investment in small and medium-sized Australian companies. PDFs invest in shares of companies with assets below $50 million. PDFs are higher-risk investments in the formative stage of development. PDF shareholders enjoy tax exemptions on earnings and capital gains, but capital losses are not deductible. Exchange-traded products, ETPs, include ETFs, MFS, and SPS. ETPs are popular for their low fees and broad asset exposure. They are open-ended investment funds that adjust unit supply based on investor demand. ETPs trade on the ASX like shares and offer exposure to various assets. Investors can build a balanced portfolio and switch asset classes using ETPs. Creation and redemption. ETPs maintain trading close to the net asset value, NAV, through creation and redemption. Issuers can increase unit supply to meet strong demand and prevent prices from exceeding NAV. If market prices fall below NAV, units can be bought back and converted into underlying assets. Arbitrage opportunities arise when ETP units trade at a discount to NAV. Arbitrage activity helps to shorten the duration of any discount. Buying and selling ETPs. The ETP market operates differently from the market for shares. Natural buying and selling volume for ETPs is typically low due to their buy-and-hold nature. ETP issuers provide liquidity by providing quotes and updating prices based on underlying securities. Market makers play a role in ensuring quick response and liquidity for large orders. Trading between 10:30 a.m. and 3:30 p.m. Sydney time is recommended. Issuers disclose the net asset value, NAV, of ETPs, which can be found on their websites or reported to the market. Legal structures of ETPs. ETFs and managed funds are registered managed investment schemes, with investors holding units in a unit trust. Structured products represent contractual obligations of the issuer, providing rights against the issuer rather than an interest in the underlying assets. ETFs can be passive index tracking investments, either physically backed or using representative sampling. Synthetic ETFs replicate asset performance synthetically and carry specific risks. Structured products replicate index or benchmark performance synthetically, especially for impractical assets like commodities. Synthetic replication in ETPs. Synthetic replication involves holding financial instruments, such as futures contracts, to simulate the investment performance of the index or benchmark. Synthetic ETPs and structured products use derivatives to achieve their investment objective. Investors in synthetic ETPs are exposed to the risk that the counterparty to the derivatives may fail to meet its obligations. Counterparty risk is greater when over-the-counter, OTC, derivatives are used, as they are not subject to central counterparty clearing. ASX imposes limits on the amount of assets reflecting money owing by OTC derivative counterparties, mitigating counterparty risk to some extent. ASX mandates eligibility requirements for derivative counterparties of synthetic ETFs to minimize the risk of counterparty failure. Active and passive funds. Active funds aim to outperform a benchmark by the fund manager's active investment decisions. The fund manager has flexibility in selecting investments within the fund's mandate. Passive funds, such as index funds, aim to replicate the performance of a benchmark index by closely matching its holdings and weightings. Index funds are an example of passive funds that do not seek to outperform the benchmark. ETFs, particularly index-based ETFs, are predominantly passive funds. Passive funds generally have lower management fees compared to actively managed funds. Active products. Managed funds within the ETP family can include both actively managed and passively managed investments. Actively managed funds are designed to achieve specific outcomes, and may aim to generate returns that are negatively correlated to the returns of a particular market index. The level of activity by the fund manager in maintaining the asset mix to achieve the performance objective can impact the management fees. Higher levels of activity and management involvement generally result in higher fees, also known as the management expense ratio, MER. Thank you for watching. Don't forget to check out our flashcards for more investment knowledge. If you found this video helpful, please like and subscribe to our channel. Goodbye.